After the collapse of Silicon Valley Bank on Friday, another bank just shut down. Regulators today abruptly closed Signature Bank. It has offices throughout New York and Connecticut.
Citing systemic risk, regulators shut down Signature Bank Sunday. The company told us no comment. The New York-based full-service commercial bank has 40 private client offices.
This is a byproduct of what we saw with Silicon Valley Bank. Uninsured depositors at any bank could start stampeding to their bank to take money out.
The Wall Street Journal reported that Signature was reeling from a bet on crypto banking. Earlier Sunday, Treasury Secretary Janet Yellen addressed the FDIC seizing control of California-based Silicon Valley Bank on Friday. It's the second largest bank collapse in U.S. history and is already affecting tech businesses it financed, including Roblox, Etsy, and Roku. It sparked alarm about reverberations amid rising interest rates.
I've been working all weekend with our banking regulators to design appropriate policies to address this situation.
Hi, welcome back to Joe Blogs. In today's video, I want to talk about the failure of a third bank in the USA in the space of 5 days. And you may be thinking, I've never heard of Signature Bank. Who cares? It's irrelevant. But this is actually the third largest bank failure in US history. In a recent video, I talked about Silicon Valley Bank being the second largest. We've now had the third largest in the space of 1 week. So what is going on in US banking? The failure of one bank could be put down to specific circumstances. The failure of two banks could be a coincidence. But the failure of 3 banks in less than 7 days tells us that there is something concerning happening in the world of finance right now. So in today's video, I'll give you more details on Signature Bank. We'll look at exactly what caused the failure. We'll talk about cryptocurrency because Signature Bank did have a relationship with crypto. However, it was relatively small in the context of the bank. We'll look at the details of the FDIC takeover and bailout that's been announced. We'll have a look at what's been happening with Signature Bank's share price and market capitalization because the company was listed on NASDAQ. We'll talk about the ongoing risk of contagion and the likelihood of more bank runs happening in the USA over the course of the next week or so. And then finally today I'll wrap up with my summary. So what I think is likely to happen in the banking sector over the course of the next few weeks and months and what the implications of this are for the global economy. Signature Bank was founded in 2001 by Joseph DePaulo, who'd formerly worked at Republic National Bank of New York before it was purchased by HSBC. 6 branches were opened simultaneously across the New York area with the goal of catering to wealthy clients and middle market business managers with assets worth more than $250,000, which is an interesting figure as obviously that's the amount that's guaranteed under the FDIC rules. Originally, the bank was established as a subsidiary of Bank Hapoalim of Israel, which originally provided around $60 million in capital to fund the bank. Unlike a lot of traditional banks, the business model was not focused on providing loans to clients, but rather used the deposits it was taking from its customers to invest into low-risk assets such as bonds. In its first few years, the bank grew rapidly, and in March 2004 completed an IPO on NASDAQ. The ethos of the bank was to grow through word of mouth and personal relationships, and despite the branches not having any street signs and the company not embarking on any advertising, between 2004 and 2014, the company's stock price rose by more than 650%, which represented a return that was 10 times higher than the S&P 500, and it became the single best performing financial institution. Interestingly, the second best performing financial institution over that period was Silicon Valley Bank. In 2017, Signature Bank expanded outside of the New York area for the first time, and in 2018 opened its first offices on the west coast of the USA in San Francisco. And this move coincided with the bank's decision to start servicing the cryptocurrency markets. Signature Bank attracted some of the biggest names in cryptocurrency, such as Coinbase, Circle, and Paxos. By the end of 2021, around 16% of all of the bank's assets came from the cryptocurrency sector. However, by February 2023, that figure had grown to around 30%. The move into cryptocurrency had a positive impact on the bank's share price, which increased from around $75 to a peak of $375 in October 2022. However, as I'm sure you'll be perfectly aware, in November 2022, FTX, the second largest cryptocurrency exchange in the world, failed when it was revealed that founder Sam Bankman-Fried had been using customer deposits to fund losses, investments, and his hedge fund, Alameda Research. And as a direct result of the failure of FTX, the crypto markets went into freefall, and this was really bad news for Signature Bank. So why has Signature Bank failed? Well, you may be sitting there thinking, well, you've just told me the answer. You mentioned crypto, everything relating to crypto is in freefall, so therefore the failure of Signature is related to crypto and has no impact on the rest of the financial world. But if we look at the facts of this case, on Friday the 10th of March, Signature Bank had total assets of $118 billion. And out of those assets, crypto-related deposits equated to 16.5, so that's around 14% of the total assets of the bank. And in fact, when you look at the history of Signature Bank and look at its business relationships, it's actually stronger in the world of law and finance. Signature Bank is known predominantly in New York for providing banking services to law firms and real estate companies, and for catering to wealthy families in the area. In fact, its most famous clients up until the Capitol Hill riots was Donald Trump's company, the Trump Organization. So with only 14% of its assets being related to crypto, you couldn't really describe Signature Bank as a crypto bank. However, the problem that Signature Bank had is that it had a number of large cryptocurrency corporate clients. However, the main problem that Signature Bank had relating to its crypto clients is that it had created a fast payment system called Signet, which was the only other alternative option for cryptocurrency clients who wanted to make fast payments alongside Silvergate's SEN, Silvergate Exchange Network. Now, as you may have seen in one of my previous postings, on the 3rd of March, Silvergate announced that it was closing its SEN network as a result of liquidity problems within the bank. And that raised alarm bells amongst all of the cryptocurrency community. They became aware that Silvergate was running out of cash, and so there was a run on that bank. And then all of the cryptocurrency businesses looked around at their other banking relationships. They looked at Signature and decided that they needed to remove all of their money from Signature before it got itself into the same situation that Silvergate was in. So as a direct result of this action, there was a run on the bank. All of these corporates wanted to move hundreds of millions of dollars that they had on deposit with Signature. And when confidence starts to fall in any financial institution, it's very difficult to be able to stop that momentum. Now, in an attempt to calm its customers, on the 9th of March, which is the day after Silvergate announced that it was going into liquidation, Signature Bank issued a press release reiterating its strong financial position and limited digital asset-related deposit balances in the wake of industry developments. This statement said that Signature Bank was a proven, stable commercial banking business with in excess of $100 billion in well-diversified assets across 9 national business lines and nearly 130 commercial banking teams, spanning its metropolitan New York area and West Coast footprint. It said the bank had a diversified deposit mix, with more than 80% of deposits coming from middle market businesses such as law firms, accounting practices, healthcare companies, manufacturing companies, and real estate management firms. It had a high level of capital, as evidenced by a Common Equity Tier 1 risk-based capital ratio of 10.42%, which is well in excess of regulatory requirements as at the end of 2022. It also had investment-grade long and short-term credit ratings, which were recently affirmed by Fitch Ratings, Kroll Bond Rating Agency, and Moody's Investor Services. In terms of its liquidity, on March the 8th, the bank held cash balances of around $4.5 billion, borrowing balances of around $6.6 billion, with additional capital of around $29 billion, marketable liquid securities of approximately $26.4 billion, deposit balances of $89 billion, which were up $576 million since the end of 2022, and these balances included the deliberate reduction in digital asset-related client deposits of almost $1.3 billion, resulting in a balance of $16.5 billion in digital asset-related client deposits. So that's basically crypto clients. Total loan balances were $71.8 billion, which represented a reduction of around $2 billion since the end of 2022, as the bank executed its previously announced strategy to reduce loan balances in its larger business lines. The statement went on to say, "We want to make it clear again that Signature Bank is a well-diversified, full-service commercial bank with more than 2 decades of history and solid performance serving middle-market businesses. We have built a strong reputation serving commercial clients through 9 business lines and reached in excess of $100 billion in assets by continually executing our single point of contact relationship-based model where banking teams are capable of meeting all client needs. As a reminder, Signature Bank does not invest, does not trade, does not hold, does not custody, and does not lend against or make loans collateralized by digital assets. We've repeatedly communicated that our relationship in the digital asset space are limited to US dollar deposits only, and we remain fully committed on executing on our plan to deliberately reduce these deposits further. Since we opened our doors, we have been a deposit-first institution and have always been committed to our depositors' safety first and foremost. As shown by our current metrics, we intentionally maintain a high level of capital, strong liquidity profile and solid earnings, which continues to differentiate us from our competitors, especially during challenging times. So when you look at Signature Bank in that context, logic should tell you that actually everything's fine. This bank is well capitalized. It's actually got relatively small exposure to the crypto markets. None of that exposure is actually speculative. They're not investing in crypto. They're not betting that Bitcoin's going to go above $50,000, for example. All they're doing is providing services to some corporates that work in the crypto industry. So when you look at all of the facts, that should give everybody confidence that this bank has long-term viability. However, as you saw at the start of the video, Signature Bank has failed. It's gone. And the basic reason for that is that its customers lost faith in the institution. When a bank run starts, nobody's reading press releases, looking at capital ratios and thinking about the long-term history of the bank. All they're thinking about is getting their money out of that bank as quickly as possible. And when you have a run, it's virtually impossible to stop it. And that's exactly what the management of Signature Bank have found. Even though they had all of these facts and figures that do make sense and logically tell you that there is no risk, nobody cared, everybody wanted to take their money out, and because it's impossible for banks to be able to give everybody all of their cash simultaneously because they've locked up all of that cash into longer term assets like bonds and loans, which are very difficult to realise, or if you do realise them, you actually incur a huge loss and therefore is detrimental to the business. Because of those dynamics and the fact that customers wanted to remove their cash, the bank was failing and needed to be bailed out. On Sunday the 12th of March, New York State Department of Financial Services issued a press release announcing that they had taken possession of Signature Bank in order to protect depositors and that the Federal Deposit Insurance Corporation, FDIC, had been appointed as the receiver. At the same time, the US Department of Treasury announced that due to systemic risk, Signature Bank had been closed by the state and that all depositors of the institution would be made whole. They went on to say that shareholders and certain unsecured debt holders will not be protected and that the senior management of the bank had been removed. The statement says that any losses to the Deposit Insurance Fund to support unsecured depositors will be recovered by a special assessment on banks as required by law. It's subsequently been reported that the FDIC has established a bridge successor bank, so a new company, which will enable customers to access their funds from Monday the 13th of March, with all Signature Bank depositors and borrowers automatically becoming customers of the new bridge bank. Former Fifth Third Bancorp Chief Executive Greg Carmichael has been appointed as Chief Executive of the Bridge Bank. New York Governor Kathy Hochul said she hoped the US government's actions on Sunday would provide increased confidence in the stability of our banking system, and many depositors at these banks are small businesses, including those driving the innovative economy, and their success is key to New York's robust economy. Regulatory filings show that around 90% of all of the bank's deposits, so around $80 billion, are uninsured under the FDIC scheme. Now, this chart shows the movement in the Signature Bank share price over the course of the last 5 years. And this shows that up until the end of 2020, the bank's share price moved around between a high point of around $150 per share and a low point of around $70. However, during the course of 2021, the bank's share price took off, and by January 2022, it was sitting at around $370, which valued the business at more than $44 billion. And the main reason for that rapid increase in the share price and the valuation of the business was because Signature Bank had developed its relationship with the cryptocurrency markets, it had launched its fast payment service, Signet, and as the cryptocurrency markets took off and everybody wanted to invest into anything crypto related, so did the share price for Signature. However, as I've talked about in other videos, in the world of cryptocurrency, what goes up must come down. And over the course of the last 12 months or so, as we've seen a number of cryptocurrency failures, The share price of Signature Bank has tanked, and prior to it being taken over by the FDIC, the share price was back down to around $70. Now, just to be entirely clear, Signature Bank has now collapsed, so the shares are completely worthless. So anybody that was holding shares in Signature Bank prior to the announcement on the 12th of March have now lost all of their money. And the reason I wanted to show this is that you might be thinking that because the FDIC have come in and said that they will guarantee all depositors' funds, that there's actually no losers. Everybody is okay because it's all been bailed out by the government. However, anybody that's invested into Signature Bank and was holding shares at the time of its collapse have obviously lost all of their investment. And this company was valued at $44 billion just over a year ago. So that value has been completely wiped out. And as with the failure of any financial institution, there will be knock-on implications. But one of the biggest implications is the simple loss of confidence. When both the market and individuals see a financial institution collapsing, it raises concerns that other institutions may also follow suit. So people with money on deposit with smaller banks and financial institutions are starting to look at their portfolio and wondering whether or not they need to move money. And over the course of the last 5 years, we have seen an explosion in the number of financial institutions. Fintech has been one of the biggest growth areas in terms of venture capital. Lots and lots of new online businesses and financial institutions have popped up. They've been taking money off people left, right, and centre, and all of those businesses are now facing the risk that all their customers will say, actually, I would like my money back and I'd like to put it with one of the big institutions because that's where I feel safest. So the investors of Signature Bank have lost all of their investment, but the risk here is that other investors in other financial institutions will also see the value of their investments falling and may also lose all of their cash. So what's the summary and conclusion today? Well, I wanted to post this video because it's rare to see a bank fail. It's very rare to see two banks fail within a matter of days, but it's extremely rare to report that 3 banks have failed in the USA in a matter of 5 days. And Silicon Valley Bank and Signature Bank are the second and third largest failures in US banking history. So the collapse of these 2 banks is meaningful. And I think what's causing the main concern is that these banks haven't failed because they got their lending strategies wrong. They lost a whole lot of money in certain markets and therefore they only have themselves to blame. The reason that these banks have failed is because their customers tried to withdraw all of their money simultaneously, and it's impossible for banks to be able to meet all of those withdrawals. They both hit a liquidity crisis and therefore had to be bailed out. And the risk of being a victim of a bank run and therefore falling into a liquidity crisis hangs over the head of absolutely every financial institution in the world. Now, when you hear about a bank run, you think of those images from the 1930s with individuals queuing around the block to try to get their life savings out of that bank. But bank runs today are very different. What we're talking about today for Signature Bank and Silicon Valley Bank are corporate bank runs. These are large institutions that are looking to take large amounts of capital out of that bank by digital transfers. So for Signature Bank, it was companies like Coinbase and Paxos looking to remove their deposits, and it's reported that both of those institutions have around $250 million on deposit. So what Signature Bank was experiencing were large electronic deposit requests of hundreds of millions of dollars. So generally speaking, people aren't queuing around the block at these banks. What they're doing is going online and trying to transfer all of their funds at the same time. And of course, it has the same impact on the bank. If you don't have that amount of available capital, you can't allow those transfers to go through. Therefore, you have to close your systems, and therefore you're no longer operating as a bank, and you have to call in either the receivers or FDIC or institution to take over. So as we've discussed in this video, the press have labelled Signature Bank as a crypto bank. So you may have seen headlines saying crypto bank Signature has collapsed, and therefore thought, well, it doesn't really matter because the whole world of crypto is going down the pan anyway. But as we've seen from the data today, the majority of the assets and customers that Signature Bank had were not crypto related. So the run on the assets really relates to that 14% of their asset base that was exposed to the crypto markets. So this really shows you the risks that a bank is looking at, because if only 14% of its customers are demanding the withdrawal of its assets and the bank can't meet that amount of withdrawals, that shows you the precarious nature of finance. So when you look at the big institutions, yes, they may have hundreds of billions of dollars of assets, but they only have a small fraction of that that's available for withdrawal at any one point. So if you start to get a build-up of customers wanting to move all of their deposits out of your bank, it can very quickly develop into a liquidity crisis. So the key question from today's video is this the start of a major financial collapse? Well, when you look at what happened back in 2008 when the global financial crisis struck, the first institution that got itself into difficulty was Bear Stearns in March of 2008. And that company was actually acquired by JP Morgan for a bargain basement price. And at the time, everybody thought that that had solved the problem, that everything had gone away. But in September of that year, that's when everything started to collapse. We saw Lehman Brothers go down. We saw multiple institutions all around the world getting into financial difficulty and having to be bailed out. So there was a 6-month lag between the first bank getting itself into major problems and the situation developing into a full-blown crisis. So what's going to happen now? Are we going to see other institutions following suit? Well, I think the proof of the pudding will be what happens over the next 3 to 6 months. At the moment, we're reporting on 3 bank failures in the USA in the space of 5 days. If we start seeing more bank failures popping up in the USA and other countries over the course of the next few weeks, then that is raising a major red flag that we are on the verge of some form of financial disaster. The facts that we know right now are that interest rates have risen rapidly over the course of the last 12 months, and that means that a lot of the assets that banks have been investing into over the course of the last few years, when yields and interest rates were very low, are now out of the money. So banks really don't want to be forced to cash any of those assets in, because that will crystallize large losses. In addition to that, over the course of the last 6 months, we've seen a slowdown in the global economy, and the outlook for the global economy is now far lower. And the third factor that materially raises the likelihood of some form of financial crisis is that there's been a huge drop in confidence. The reason that these 3 banks failed was because there were runs on their accounts. Customers wanted their money out because they believed that those institutions were at risk of failure. And that is contagious. That sort of thought process will spread very quickly all around the globe. And as soon as any customers of any financial institutions hear that there's a risk of that institution going bust, they will want to take their money out very quickly. That then causes another run and potentially another failure. So when you look at all of the ingredients, there is a very real possibility that we are now sitting on the verge of another global financial crisis. So hopefully you've enjoyed the content of today's video. You found it interesting, useful and thought-provoking. If you've liked what I've said, then please give me a thumbs up. And thank you so much for watching this video all the way through to the end. And here's the payoff.